Well, usually when we talk about a company's financial structure, or I guess when you watch financial news networks, there's this uh, massive, overwhelming focus on ownership.
Oh, absolutely. It's all about the stock market.
Right. You buy a stock, you become a part owner, you get a voting right, you can actually attend the annual general meeting.
Yeah, the CEO stands up on a stage and basically tells you, we're all in this together.
Exactly. There's a real sense of community, a shared journey. Like you're part of the team.
It feels highly democratic. I mean,
Oh,
you're sharing in the massive upside if the company, say, invents the next big thing,
yeah.
but you're also sharing the total devastating wipeout if the company goes bankrupt. You are an owner, for better or worse.
Which is exciting, right?
Yeah.
But then you step into the world of fixed income. You step into the debt markets.
And suddenly that warm, fuzzy community feeling is just completely gone.
Yeah, it's a completely different landscape.
Mhm.
Honestly, it's quite cold, it's deeply mathematical, and it's ruthlessly binding.
It is the absolute definition of a legal obligation. Like in the bond market, there is no we are in this together.
Right.
There is only you owe me and you will pay me this exact amount on this exact date, or I will literally take your company apart piece by piece.
I love that. And that ruthlessly binding world is exactly where we're taking you today. Welcome to the deep dive.
We're excited to get into it.
And I know exactly who is listening to this right now. You are an MBA student, and you are staring down the barrel of a crucial exam on fixed income securities valuation.
Yeah, you probably have a mountain of study material filled with Greek letters and formulas.
Formulas that look like ancient hieroglyphs.
Yeah.
Right. And enough financial jargon to make your head spin right off your shoulders.
It can feel incredibly overwhelming, especially, when the clock is ticking down to exam day.
Oh yeah, panic mode.
Right, and you feel like you're just trying to memorize this chaotic soup of definitions and algebra.
But take a breath. Seriously, put down the highlighter for a second, because your mission today and our mission is to completely deconstruct this material.
We're going to extract every single vital concept you need to know for that exam.
But we aren't just going to read you a table of contents. We're going to translate that complex math into intuitive real-world scenarios.
Exactly. We're going to build mental frameworks so that when you sit down for that exam, you aren't just blindly regurgitating formulas.
You're actually going to understand the underlying architecture of global finance. You're going to crush it.
And what's genuinely fascinating here is that while everyone else in your cohort might be obsessing over the equity markets.
Because stocks are flashy, right? They make the evening news.
Right, they have charismatic CEOs. But the bond market is actually the massive underlying bedrock of the entire global economy.
It's so much bigger than the stock market, which people always forget.
Far, far larger. So my goal by the end of this conversation is to give you the calm, quiet assurance that you won't just know how a valuation formula works.
You'll understand exactly why it works and why human beings designed it that way in the first place.
Exactly.
Okay, so let's unpack this from the absolute ground up. Let's start with the foundational bedrock. What actually is a bond?
Right. Let's strip away the Wall Street jargon.
At its core, a bond, or a debenture, if you see that word on the test, is just a fixed income security that represents borrowed capital. It's a loan.
Precisely. That is the core identity you must keep front and center in your mind.
Just a loan.
Yes. When you buy a bond, you're not buying a piece of the company. You're basically playing the role of the bank. You are lending them your capital.
And in return, the issuer, whether that's a massive corporation or the government, takes on a strict, legally enforceable obligation.
Right. They are legally bound to pay you regular interest and then, crucially, to return your original principal amount on a specific maturity date.
I want to lean into that legal obligation part because it is a massive differentiator for the exam. If the issuer fails to pay, you don't just send an angry email.
No, you initiate legal proceedings. You literally drag them into a courtroom.
It's not like a stock dividend at all. With a stock, the board of directors can just shrug their shoulders.
Yeah, they can just say, sorry, folks, it was a bad quarter, macro headwinds, supply chain issues, so 0 dividends this year.
And as a shareholder, you just have to swallow it. You can't sue them for not paying a dividend.
But that is the perfect contrast. With a bond, the CEO cannot shrug. If they miss an interest payment, they are in default.
Boom. Default.
Yeah.
And that brings us to the absolute must-know features that will undoubtedly show up on your MBA exam.
If you are comparing debt and equity, you really need to know the trade-offs.
So feature number 1 of a bond, a fixed return in the form of interest. You know exactly what cash is coming into your account and when.
And feature number 2, which is huge, preference in repayment at the time of winding up.
Okay, I want to pause here because this is like my favorite mental model for this topic. I call it the lifeboat rule.
Oh, I like that. Let's hear it.
So imagine a company is a massive ocean liner. Let's say you and I started an airline together, and we raised money by selling both stocks and bonds.
Okay, tracking.
But terrible management, probably my fault, and high fuel prices mean our airline hits an iceberg. We're going bankrupt.
A total disaster.
Right. So we're liquidating the assets. We're selling off the airplanes, the terminal gates, the office chairs, the staplers. We're gathering whatever cash is left.
Okay.
Who gets to get in the lifeboat first? Who actually gets that cash we scrounged together?
The bondholders,
Hmm.
the lenders. That preference in repayment is the critical defining difference from equity.
So the shareholders are just stuck on the deck.
The shareholders are the absolute last ones on the sinking ship.
Yep.
The bondholders legally get to stand at the very front of the line to recover their money.
Wow.
And only if every single bondholder is paid back in full does a single penny trickle down to the equity shareholders.
So for the listener preparing for the exam, think of buying a bond as being a silent VIP bank.
That's exactly it.
If I buy a share, I'm a part owner. I get to go to the annual meetings, I get a voting right, I can complain at the microphone, but I might get zero dividends.
And if the company goes under, your stock goes to zero. You lose everything.
Right. But if I buy a bond, I'm the lender who sits back. I have absolutely zero say in how the CEO runs the company, no voting rights.
But as the VIP, you legally get paid first. You trade control for security.
That is exactly the mental framework. I trade the limitless upside of a stock price going to the moon in exchange for a legally enforceable contract.
A contract that guarantees a fixed return and VIP treatment in a bankruptcy court.
Exactly.
You also need to keep in mind that these debt instruments are traded in the debt market segment of the capital markets.
Right. And they can sometimes come with special conversion or redemption options, which we'll explore in a minute. But I want to pivot this to the specific Indian market context for a second. Because understanding the theory is one thing, but applying it to the real world is another. If we look at the Indian bond and debt market, there are specific structural advantages that make it attractive. And in an MBA context, this is prime material for essay questions.
Right, like why would a portfolio manager in Mumbai actively choose to allocate massive amounts of capital to the debt market instead of just riding the stock market?
Exactly. Why not just buy stocks?
It comes back to a logical progression of risk management. The primary advantage is the security of return and the safety of the investment.
Which leads to a drastically reduced risk of capital loss, right?
Yes. Because of that legal obligation we just discussed, the cash flows are highly predictable.
Right, and that predictability pairs directly with the second major advantage.
Yeah.
Incredibly low price volatility compared to equity.
We've all seen stock markets bounce up and down wildly based on, a single tweet from a tech billionaire or a minor political rumor.
Oh yeah, it's wild. But bonds are much more stable because the underlying math is locked into a contract.
Furthermore, in the Indian market specifically, you have the availability of a relatively risk-free investment mode through government securities.
Okay, break that down. Risk-free.
Well, when you lend to the central government, the default risk in local currency is practically zero, because the sovereign government can, in theory, always print more money to pay its local currency debts.
Ah, right. That risk-free rate basically anchors the safety of the entire financial system.
Exactly.
Now, here's a concept that sounds like high-level Wall Street jargon, but it's deeply important for the exam. The text notes that the bond market enables wide portfolio diversification.
Yes, very important.
Specifically, it mentions that bonds enable duration adjustment in portfolio management. I really want to spend some time on this.
Yeah.
What on earth is duration adjustment?
I know, it sounds intimidating. But the concept is actually very physical. Duration is essentially a mathematical measure of how sensitive a bond's price is to changes in interest rates in the broader economy. By adding different types of bonds, say some that mature in 1 year and some that mature in 30 years, a portfolio manager can precisely adjust the overall duration or sensitivity of their entire wealth.
So let me try an analogy here. It's like adjusting the suspension on a car, maybe.
Oh, why?
If you're driving a sports car and you think the road ahead is going to be incredibly bumpy and chaotic, meaning you think interest rates are going to swing wildly, you want to tighten up your suspension.
Right.
So you buy bonds with a very short duration. They are less sensitive to the bumps.
Exactly.
But if you think the road is going to be perfectly smooth and flat for miles, you might loosen the suspension, buy long-duration bonds, and capture a higher yield.
That is a brilliant way to visualize it.
Yeah.
You are engineering your exact risk profile. You can finely tune your exact exposure to the macroeconomic road. You simply cannot do that with just a portfolio of stocks.
That makes so much sense.
And the final advantage to note for the Indian market is the heavy reliance on independent credit rating agencies.
Right, because investors aren't just flying blind, hoping a company is telling the truth about its finances.
Exactly. There are professional third-party agencies rigorously grading the homework of these corporate borrowers, which gives the market a foundation of trust.
Which is huge. We'll definitely be diving deep into how those agencies operate later on.
We will.
Okay, so we've established a foundation. We know what a bond is conceptually. It's a legally binding loan. You're the silent VIP. You get the lifeboat first.
Right.
But knowing the concept is only step one. Step two is recognizing the different flavors of bonds out there in the wild. Let's walk through the zoo of debt instruments.
I actually love the zoo analogy because the debt market is entirely bifurcated into two massive, distinct habitats: government securities and corporate securities.
Okay, let's look at habitat number one, government securities. These are often referred to historically as gilt-edged securities, or GSECs.
Yes.
I've always loved that term. It sounds like a prop from like a Victorian period drama. Why gilt-edged?
It is a historical term. Centuries ago, British government bonds were literally printed on physical paper certificates that had actual gold gilt applied to their edges.
Oh, wow. Literally gold edges.
Yeah, it was a visual signal of ultimate wealth, synonymous with the highest possible quality and absolute safety. In the modern Indian context, these GSECs are issued by the Reserve Bank of India, the RBI, acting on behalf of the Government of India.
So for someone taking the exam, the key associations to make with GSECs are: they are issued by the RBI, they're generally medium to long-term instruments, and the interest accrual is usually semi-annual.
Meaning, as the lender, you get a reliable check every 6 months.
Nice. And while the central government is the main player, other government agencies and state governments issue bonds too, right?
Yes, and they are often guaranteed by the central government to maintain that gold standard safety.
Okay, so if you're a student and you see gilt-edged or GSEC in a question, your brain should immediately route to sovereign backing, RBI, maximum safety, semi-annual payouts. All right, now we open the gates to the second, much wilder habitat, corporate securities.
This is where public sector and private sector companies issue debt to fund their operations.
And there are 8 very specific types of corporate bonds you need to be familiar with for the exam. Let's break down the defining trait, the core mechanism of each one.
We will start with the baseline, the foundation that everything else builds upon. Number 1, straight bonds, also known universally as plain vanilla bonds.
Plain vanilla. It is exactly what it sounds like. No sprinkles, no hot fudge, no surprises.
Exactly.
You lend the company 1,000 rupees. They promise to pay you 7% interest every single year for 5 years. At the end of 5 years, they hand you your 1,000 rupees back.
It's a fixed periodic return and a return of principal on maturity. It is boring, it is reliable, it is the textbook definition of a loan.
And everything else is a mutation of that vanilla structure, right?
Right. So, mutation number 2, floating rate bonds. Here, the interest rate is not fixed at 7%.
Okay, so what does it do?
Instead, it is linked to a moving benchmark rate in the broader economy. A common example would be linking it to the interest rate of short-term treasury bills.
But why would an investor want that? Why not just lock in a guaranteed rate so you know exactly what you're getting?
Because of the fear of inflation.
Ah,
If you lock in a 5% return for 10 years, but suddenly global inflation skyrockets to 8%, your real wealth is basically being destroyed.
right, because things cost more.
Exactly. But with a floating rate bond, if the broader economy heats up and the central bank raises the benchmark rates to fight inflation, your bond's interest payout automatically floats up with it. It protects your purchasing power.
That's super smart.
Of course, if rates drop, your payout drops too. It floats on the economic tide.
Okay, that makes total sense. It's an inflation hedge. Number 3 is a fascinating one. Zero coupon bonds.
Yes.
Now, if I am a novice investor, the name sounds like a terrible pitch. Hey, do you want to buy this bond? It has 0 coupons, meaning we're going to pay you 0 regular interest payments. Why on earth would anyone buy that?
It seems completely counterintuitive until you look at the pricing. Yes, they carry no fixed periodic interest payments, but they are issued at a massive discount to their face value.
Okay, wait, let me make this tangible. The face value is 1,000 rupees. But I don't buy it from the company for 1,000 rupees.
No, you don't.
I buy it today for, let's say, 600 rupees. I hold it in a vault for 5 years. I get 0 texts in the mail. It's totally silent.
Right.
But at the end of year 5, I hand them the certificate, and they hand me the full 1,000 rupees. So my entire profit, the 400 rupees, is captured in that final single moment.
Exactly. You get it all at the end.
But again, why would someone buy this instead of getting regular checks?
Well, imagine a massive pension fund. They know they have a huge wave of teachers retiring in exactly 12 years.
Okay.
And they need exactly 1 billion rupees in cash on that exact date to pay pensions. If they buy regular bonds, they get interest checks every year, sure, but then they have to figure out how to reinvest those small checks safely.
Oh, which introduces risk.
Exactly. With a zero coupon bond, they can invest 600 million today, lock it in a vault, and guarantee they will have exactly 1 billion in 12 years. It perfectly matches their future liability without the headache of managing interim cash flows.
That is a phenomenal real-world application. Okay, number 4, convertible bonds. This is like the shapeshifter of the financial world.
It really is. It offers regular income, but gives the holder the option to convert the bond into a predetermined number of equity shares.
So this is all about human psychology, isn't it?
Yeah.
Investors want safety, but they also experience FOMO, fear of missing out.
Definitely FOMO. You
Yeah.
start out as a bondholder, you have the lifeboat guarantee, you are getting your safe, vanilla interest payments.
Right.
But let's say you lent money to a small tech company and suddenly they invent a revolutionary AI chip. Their stock price is doubling every week.
And as a regular bondholder, I don't get to participate in that upside. I just get my boring 7%.
Right. But with a convertible bond, you can flip a switch.
I can call the company and say, tear up my debt contract. I am trading in my bond. And in exchange, I want the 10 shares of stock you promised me in the contract.
Yes, you give up your lifeboat VIP status, you become an equity owner, and you ride the rocket ship to the moon.
It's the ultimate hybrid. Downside protection with upside optionality.
Exactly. And that leads us directly into a massive trap for MBA students. Bond type number 5, participating bonds.
Okay, everyone, perk your ears up for this one.
These have a guaranteed rate of interest, but also entitle the holder to an additional specified percentage of the company's earnings.
Right, so do not confuse convertible bonds with participating bonds. This is a classic conceptual trick on exams. How do we keep them straight in our heads?
Well, let's go back to the tech company scenario. You want the upside of the AI chip discovery.
Right. If I have a convertible bond, I legally transform into a shareholder. I literally swap my bond for stock.
Yes.
But if I have a participating bond, I would call it the I want to slice the cake too bond.
That is a great way to phrase it. With a participating bond, you do not transform. You remain a bondholder.
I keep my VIP lifeboat status.
You keep the lifeboat status. You keep getting your fixed interest. But the contract says, hey, if the company has a record-breaking profit year, the bondholders legally get to participate and take a bonus slice of those profits.
So I stay debt, but I take a cut of the equity's victory.
Exactly. Convertible changes into equity. Participating stays debt but gets a bonus. Memorize that mechanical difference.
Awesome. Let's move to number 6, sinking fund bonds. The mechanism here is that a specified amount of money is kept aside each year to retire the bond issue, and it's usually paid to a sinking fund agent who acts as an independent trustee.
Right. To understand why this exists, put yourself in the shoes of a skeptical lender.
Okay, I'm skeptical.
Suppose a corporation wants to borrow 100 million rupees from you for 10 years. As an investor, you might look at their volatile business model and worry.
I'd be thinking, sure, they could pay the annual interest, but in year 10, when the principal comes due, are they actually going to have 100 million in hard cash just lying around?
Right, or will they default on the massive final balloon payment?
It's a huge cliff to jump off. So a sinking fund forces discipline.
Exactly. It forces the company to put, say, 10 million rupees every single year into a locked third-party trust account.
So by the time year 10 rolls around, the 100 million is already sitting there in a vault waiting for me. It's basically a forced savings account for the borrower, so they don't leave me empty-handed at the finish line.
It drastically lowers the risk for the lender, which usually allows the company to borrow at a slightly lower interest rate. It's a win-win built on enforced discipline.
Makes sense. Number 7 is mortgage or secured bonds. These are covered by the security of specific assets.
This one is very straightforward. It's exactly like a home mortgage.
If you don't pay your home mortgage, the bank takes your house. If a corporation doesn't pay its secured bond, The bondholders get to legally seize the collateral.
Exactly. That might be a specific factory, a fleet of delivery trucks, or a parcel of land. It gives the lender tangible hardware they can sell to get their money back.
And finally, number 8, commodity-linked bonds.
Here, the return is not linked to a financial benchmark like a treasury bill, but instead depends on the price of an underlying physical commodity.
So if an airline issues a bond, they might link the return to the price of jet fuel.
Yes. Or a mining company might link it to the price of gold or copper. It is highly specialized, almost like blending a bond with a commodities derivative.
Exactly. So that is your zoo. You have the vanilla foundation, the floating inflation hedges, the zero coupon discount plays, the shape-shifting convertibles, the profit-sharing participating bonds, the forced savings sinking funds, the asset-backed secured bonds, and the commodity-linked hybrids.
Understand the core mechanism of each, and you will navigate any question they throw at you regarding debt classification.
All right, let's take a deep breath here, because knowing what a bond is legally and knowing its flavor profile is really just the setup. It's the terminology.
Now we have to roll up our sleeves and figure out exactly what these pieces of paper are actually worth in cold, hard cash today.
And that brings us to the mathematical heart of this subject, the core math, valuation, and the time value of money.
This is where a lot of students freeze up because they see a page full of algebraic summation formulas.
Yes, it's sigma signs. Terrifying.
But if we strip away the Greek letters and focus on the underlying logic, it is deeply, profoundly intuitive. The golden rule of all fixed income valuation comes down to one sentence. The intrinsic value of a bond is exactly equal to the present value of its expected future cash flows.
I want to repeat that, because if you understand that one sentence, the entire mathematical apparatus of global finance unlocks for you. The intrinsic value of a bond today is simply the present value of its expected future cash flows.
And to find that present value, we have to use discounting techniques. This is entirely based on the concept of the time value of money. The fundamental truth of finance is that a single rupee placed in your hand today is fundamentally worth more than a single rupee promised to you 5 years from now.
Why? Because of opportunity cost. If I have a rupee in my hand today, I can walk down to the bank, put it in a savings account, and earn interest on it for 5 years. It grows.
Exactly.
But if I have to wait 5 years for you to give me that rupee, I am being robbed of 5 years of growth. So to figure out what a future payment is fairly worth to me right now, today, I have to mentally strip away that implied interest. I have to run the tape backward. I have to discount it.
Think of discounting as inflation running in reverse. We are shrinking the future money down to its true size today.
Let's make this incredibly practical by walking through the first valuation category.
Yeah.
Bonds with a defined maturity period.
Okay, let's build a scenario. Let's introduce Mr. A.
Okay, Mr. A.
Mr. A is looking at a bond issued by our hypothetical airline. The contract says it is a 5-year bond. The face value, the principal, is 1,000 rupees, and the airline is promising a nominal interest rate of 7% a year.
First, we need to map out the physical reality of what Mr. A is going to receive in the mail. If he buys this bond, the airline is legally obligated to mail him a check for 70 rupees at the end of year 1.
Right, 7% of 1,000.
Another check for 70 rupees at the end of year 2, and year 3, and year 4. Finally, at the end of year 5, they mail him his final 70 rupee interest check, plus a massive check returning his 1,000 rupee principal.
That is the fixed reality of the contract. 5 small checks, 1 big check. But here is where the valuation magic happens.
Okay, show me the magic.
Mr. A is a savvy investor. He looks at the macroeconomic environment, he looks at the risk of our airline, and he decides, I refuse to invest my capital unless I earn a 10% return.
10% is his required rate of return. But the bond only pays 7%. So how much should he actually pay for this bond today?
This is where we discount. We take every single one of those future checks and shrink them down by Mr. A's required 10% penalty for every year he has to wait.
Okay, let's look at year 1. He gets 70 rupees, but he has to wait a full year to get it. So we discount it by 10%.
Mathematically, 70 rupees in 1 year is only worth about 63 rupees and 63 pays to him today.
Let's move to year 2. He gets another 70 rupees. But this time, he is forced to wait 2 whole years. He loses 2 years of opportunity. So we have to discount it twice as hard.
Right. That year 2 70 rupee check is only worth about 57 rupees and 82 pays to him today.
Year 3, he waits 3 years. That 70 rupees shrinks down to about 52 rupees today.
Year 4, he waits 4 years. It shrinks to about 47 rupees.
Year 5, the final interest check. He waits 5 years. That 70 rupees is only worth about 43 rupees today.
So we've discounted all the interest. If we add up the present value of those 5 shrunk down interest payments, the 63, the 57, the 52, the 47, and the 43, it totals up to roughly 265 rupees.
That is the true present value of the entire interest stream to Mr. A. But we aren't done. The grand finale. At the end of year 5, he also gets his 1,000 rupee principal back.
Right, and we have to violently discount that massive chunk of money because he had to wait half a decade for it.
Wow, violently discount. I like that.
Yeah, discounting 1,000 rupees by 10% every year for 5 years shrinks its present value down to just 621 rupees today.
Now, we add the two components together. The present value of the interest stream, which was 265, plus the present value of the principal return, which is 621.
And when you add them together, you get a total intrinsic value of 886 rupees.
And this is the conceptual breakthrough you need for the exam. This is the underlying mechanism of the entire global bond market. The bond has a face value of 1,000 rupees. The airline says it is a 1,000 rupee bond.
But its mathematical intrinsic value to Mr. A is only 886 rupees.
Why? Because the bond is stingy. It's only paying a 7% coupon, but Mr. A and the broader market are aggressively demanding a 10% return.
The only way to resolve that mathematical conflict is through price. Because the bond's cash flows are rigidly fixed by a legal contract, 70 rupees a year, period, the price of the bond itself must drop below its 1,000 rupee face value. It must sell at a discount.
It's like a negotiation mechanism. The bond says, I can only give you 7% interest. Mr. A says, I need 10%, so I won't buy you.
Right.
The bond says, okay, what if I sell myself to you at a discount? What if you only pay 886 rupees today, but I still promise to hand you a full 1,000 rupees at the end? That extra capital gain you make at the end will perfectly make up the difference between the 7% I'm paying and the 10% you demand.
That is precisely how it works. The price adjusts to force the yield to match the market's demand.
Okay.
If the market required a 7% return and the bond paid 7%, the price would be exactly 1,000.
Because it matches perfectly.
Right. But if the market only required a 5% return, but the bond paid a juicy 7%, investors would fight over it, driving the price up to a premium, say 1,100 rupees, until the effective yield dropped back to 5%.
Price and yield are a constantly balancing seesaw. I love that. The price adjusts to force the yield.
Now let's move to category 2 in valuation, bonds with perpetuity.
Perpetuity. This is a fascinating theoretical construct. A perpetuity is a bond that has no maturity date whatsoever. It literally pays interest forever, into infinity.
The principal is never, ever returned to you. You just get an interest check every year until the end of time.
Forever. It's like buying a permanent stream of water. Now, calculating the present value of an infinite number of cash flows sounds like it would require impossible calculus.
But the formula is actually the most elegant and simple equation in all of finance. It is simply the intrinsic value equals the annual interest in rupees divided by the required rate of return.
Let's use an example. A company issues a perpetual bond that pays 90 rupees in interest every single year. Forever.
If your required rate of return, your discount rate, is 9%, what is the bond worth? You simply take the 90 rupees and divide it by the decimal 0.09.
And the answer is exactly 1,000 rupees.
It's incredibly clean. But the real reason you need to understand perpetuities is because they perfectly illustrate the most heavily tested concept in fixed income. I call it the inverse rule.
Oh, this is so important.
Let's look at what happens to the value of that perpetual bond when market interest rates change.
Okay, scenario A. The market rate is 9%. The bond is worth 1,000 rupees.
Scenario B. Suddenly, the central bank slashes interest rates. The market rate drops to 8%. We take our 90 rupee fixed payment and divide it by 0.08.
The value of our bond shoots you P to 1,125 rupees.
Scenario C. Inflation panics the central bank. They hike rates up to 10%. We take our 90 rupee payment divided by 0.10.
The value of our bond violently drops down to 900 rupees.
This is the inverse rule. You must burn this into your memory for the exam. When macroeconomic interest rates go up, the prices of existing bonds go down.
And when macroeconomic interest rates go down, existing bond prices go up. They move in exact opposite directions.
Always.
Always. Makes intuitive sense, right? If I own an old bond paying 90 rupees and suddenly banks start issuing brand new bonds paying 100 rupees because rates went up, nobody wants my old stingy bond anymore.
Right.
The only way I can sell it is by slashing the price.
Exactly. The old bond must be discounted until its effective yield matches the shiny new reality of the market. And that brings us to category 3, the granddaddy of all bond calculations. Yield to maturity, or YTM, and its cousin, yield to call.
Until now, we've been playing a specific game. We knew our required return, and we used it to calculate what the price should be. YTM completely flips the script. In the real breathing world of finance, you don't calculate the price. You just open your laptop, look at a Bloomberg terminal, and the glowing green number tells you exactly what the bond is trading for right this second. The price is a known fact.
YTM asks a different question. It asks, if I log in, buy this bond at this exact market price today, and hold it in my vault until the day it matures, what is the true annualized percentage interest rate I am actually earning on my money?
It is the great equalizer. It allows you to compare a 3-year zero-coupon bond with a 10-year floating rate bond on an apples-to-apples basis.
Now, mathematically, finding YTM is actually an exercise in trial and error.
Wait, hold on. Trial and error. We're doing MBA-level finance, and the official method is essentially guess and check.
I mean, without a financial calculator or software, yes. Because of the complex geometry of compounding interest over time, it is very difficult to algebraically isolate the rate variable in a long bond formula. So you have to guess a rate, run the discounting math, see if the present value matches the current market price, and if it doesn't, you adjust your guess up or down and try again.
Let's walk through the mechanics of a scenario to see how a human investor actually uses this.
Okay, fire away.
Let's say I am looking at a bond currently selling on the open market for 8,750 rupees. It has 4 years left to maturity. The face value is 10,000 rupees.
Got it.
It has an 8% coupon rate, meaning it pays 800 rupees a year. And based on the risk, I require a 10% return on my investments. The scenario asks two things. First, what is the intrinsic value based on my 10% requirement? Second, what is the actual yield to maturity at the current market price?
Step 1 is identical to our first exercise. We find your personal intrinsic value by discounting the cash flows at her 10% required rate. The cash flows are 4 annual checks of 800 rupees, plus the 10,000 principal at the end of year 4. If we discount 800 for 1 year at 10%, 800 for 2 years, 800 for 3 years, and 10,800 for 4 years, and sum them all together, we get an intrinsic value of approximately 9,366 rupees.
Okay, stop right there. My math, based on my strict 10% requirement, says this bond is fundamentally worth 9,366 rupees to me.
Yes.
But I look at the market screen, and a desperate seller is offering it for only 8,750 rupees. The market is severely underpricing it compared to my valuation.
Exactly.
I am buying a 9,300 rupee asset for 8,750. The decision is obvious. I should aggressively buy this bond.
Correct. You have found a bargain. Now, for step 2, what is the actual yield to maturity? What is the real rate you were earning by buying it at that massive discount?
Right, because I'm getting a deal.
We know the price is 8,750. We know the cash flows. We need to find the magic discount rate that makes the present value of those cash flows perfectly equal to 8,750.
This is the trial and error part. If I guess an 11% discount rate and run the math, the present value is still a bit too high, so I need to discount it harder.
That's right.
I guess 12%. I run the math. Bingo. The present value hits 8,750 perfectly. The YTM is exactly 12%.
And because that 12% actual yield is significantly higher than your required baseline rate of 10%, it confirms your earlier decision. It is a fantastic investment.
Okay, I get it now.
Now, we must briefly touch on yield to call, or YTC. It is mechanically identical to YTM, but it deals with a specific trapdoor built into some corporate bonds.
Wait, a trapdoor?
Yes, a call feature. This is a clause in the indenture that entitles the borrowing company to call the bond back, essentially forcing you to sell it back to them before the actual maturity date.
Oh, well.
They will have a pre-published schedule that says, for example, we reserve the right to forcefully buy this bond back in year 3 for a specific call price of 1,050 rupees.
But why would a company do that to me? If I bought a 10-year bond, I want 10 years of interest.
They do it because macro interest rates dropped. If a company issued 10-year bonds at 8% and 3 years later global rates dropped to 4%, the company is furious. They're overpaying for debt.
Ah, of course.
So they open the trapdoor, they exercise the call feature, force you to take your money back, and then they immediately issue brand new bonds to the public at the new cheap 4% rate. It's a refinancing maneuver.
It's like refinancing a home mortgage when rates drop. So for the investor, if a bond has a call feature, calculating yield to maturity is a bit of a fantasy because the company will almost certainly kill the bond early if rates drop.
Exactly. So instead, you calculate the yield to call. You run the exact same trial and error math, but instead of using 10 years as the timeline, you use the 3 years to the call date.
And instead of using the face value as the final payout, you use the stated call price.
Right. It gives you the true yield, assuming the company pulls the ripcord. It prepares you for the worst-case scenario of having your great investment snatched away from you.
All right, we have conquered the math, but here's the reality check. Valuing a bond assumes everything goes perfectly. The math is clean, sterile, and assumes the future behaves exactly as the contract dictates.
But in the real world, things go spectacularly wrong.
Let's look at the systemic risks that can absolutely destroy that carefully calculated intrinsic value. We are entering the danger zone. Bond risk analysis.
Risk analysis is paramount. Returns must always be viewed in terms of the risk involved in achieving them. There are 6 specific specters that haunt a fixed income investor: interest rate risk, inflation risk, default risk, liquidity risk, reinvestment risk, and real interest rate risk.
Let's do a massive deep dive into interest rate risk first, because it is universally known as the market risk. It is the systematic risk that affects every single bond in existence.
We touched on this with the inverse rule. When weights go up, prices go down. But there are 2 crucial laws of physics regarding price sensitivity that you absolutely must understand for the exam.
Okay, I'm ready.
Law number 1. The longer the time to maturity, the greater the sensitivity of the bond's price to changes in the interest rate.
And law number 2.
Law number 2. The larger the coupon payment, the lower the sensitivity of the price.
Okay, how do we visualize this abstract sensitivity?
Let's build a physical model. Imagine a classic playground seesaw. A long wooden board balancing on a pivot point in the absolute center.
Okay, I picture it. The pivot point in the center represents the macroeconomic interest rate set by the central bank.
Right.
The far ends of the wooden board represent the price of our bond. When the pivot point, the interest rate goes up, the price ends go down. The inverse relationship in physical form.
Beautiful. Now think of the time to maturity as the physical length of the wooden seesaw board. A 1-year bond is a very short, stubby little seesaw.
So if the central bank wiggles the interest rate pivot in the middle by 1%, the ends of that short board only move a tiny bit up or down. It has very low sensitivity.
Exactly. But a 30-year treasury bond, that is a massively long seesaw board stretching all the way across the playground.
So if the central bank wiggles that pivot by just 1%, that tiny movement is amplified across the massive length of the board, creating a violent, catastrophic swing up or down at the far ends. The price swings wildly.
That is why longer maturity equals massive sensitivity. It's a perfect visualization. The longer your capital is locked into a fixed contract, the more vulnerable its present value is to being crushed by compounded discounting over time.
Okay, now apply the second law to the seesaw. The larger the interest payment, the coupon, the lower the sensitivity.
Think of those large annual cash payments as heavy lead weights attached near the center pivot of the seesaw.
Ah, I see.
The heavier the weights in the middle, the harder it is for the seesaw to swing wildly. The cash flows anchor the volatility.
Conversely, a zero-coupon bond has absolutely no cash flows in the middle. All of its value is concentrated at the very tip of the seesaw in year 30. It has no stabilizing weights.
Therefore, a 30-year zero-coupon bond is the most hypersensitive, volatile, fixed-income instrument in existence.
That is incredibly clear. Anchor your understanding to the seesaw. Let's move to risk number 2, inflation risk. This one is insidious because it doesn't show up on your brokerage statement.
No, it doesn't. It is defined as a measure of the rate of exchange between the current value of a rupee and its future value.
It is the silent thief of purchasing power. You might hold a bond for 10 years. The company never defaults. They pay every coupon. In year 10, they hand you your 1,000 rupees. The math worked perfectly.
But if inflation has raged at 8% a year for a decade, that 1,000 rupees buys you significantly fewer groceries or petrol or housing than it did 10 years ago.
You made money nominally, but you suffered a devastating real loss of wealth.
There is an economic formula to describe this called the Fisher effect. Conceptually, it states that the nominal rate you see printed on the bond is actually an illusion. It is made up of two components mashed together.
The formula is essentially your nominal rate equals your real underlying return multiplied by the expected inflation rate.
To put it in plain language, if you buy a bond paying 7%, you are actually getting 7% richer. If expected inflation is 4%, then your real return, the actual increase in your ability to consume goods, is only roughly 3%.
The other 4% is just treading water against rising prices.
Exactly. If an inflation suddenly spikes to 6%, your real return is crushed down to just 1%. You are bearing the risk that inflation expectations are wrong.
Let's talk about risk number 3, default risk. This is the nightmare scenario. Bankruptcy. The borrower's business model collapses, and they cannot pay the principal or the interest.
But it's not always a total wipeout. The text makes a nuanced point. Even if there is just a delay in payment, with no eventual loss of principal, the present value of the debt is still substantially reduced.
Time is money. If I owe you 1,000 rupees on Tuesday, but I call you and say things are tight, I will pay you in exactly 1 year. I haven't stolen your principal.
No. But you have robbed me of an entire year's worth of interest I could have earned if I had that cash and put it in bank. The present value of your debt drops.
Furthermore, the market trades on perceived risk, not just actual default.
Oh, absolutely. If a company has a bad quarter, investors perceive a higher risk of default. They panic and sell the bond, driving the price down.
Even if the company ultimately survives and pays, the interim price volatility is a massive risk if you need to sell the bond before maturity.
Which brings us perfectly to risk number 4, liquidity risk. Liquidity is essentially the ease with which you can convert an asset into cash without taking a massive loss.
Stocks are highly liquid. Millions of shares trade every second. But corporate debt instruments generally have very low liquidity.
This is a structural issue. Debt market activities occur mostly in the primary market, meaning massive institutions buy the bonds directly from the corporation when they are first minted, and they intend to hold them for 20 years.
But what if you are a smaller investor, you hold a bond, and suddenly you have a medical emergency in year 3 and need cash?
You have to go to the secondary market and find another investor willing to buy your specific obscure corporate bond.
And if it's a bond from a mid-sized cement company that nobody is following, there might literally be 0 buyers that day.
Exactly. You might have to drastically slash the price, say, offer your 1,000 rupee bond for 700 rupees, just to entice someone to take it off your hands.
That lack of a deep active trading pool is liquidity risk. You are trapped in the asset.
Exactly. Now let's explore risk number 5, reinvestment risk. This is perhaps the most counterintuitive risk for new students because it usually hurts you when things seem to be going great.
I'm going to set up a painful scenario for this one. Let's say I am a brilliant investor. I time the market perfectly. I lock in a 10-year bond, paying a juicy, massive 12% interest rate.
Sounds great.
Every year, I get a massive check in the mail. I am thrilled. My YTM calculation says I'm going to be rich. But in year 3, the global economy crashes. Central banks panic and slash interest rates down to 2% to stimulate growth.
Oh, no.
I get my 12% coupon check in the mail. I take it to the bank to reinvest it, to get that sweet compounding growth. And the bank teller looks at me and says, sorry, we can only offer you 2% on this cash now.
That is the trap. The yield to maturity calculation you did on day 1 made a massive hidden assumption. It assumed you would be able to reinvest every single interim coupon check at that exact same 12% rate for the entire 10 years.
Right.
But because market rates plummeted, you are forced to reinvest your cash flows at a miserable 2%. Therefore, your overall compounded return over the 10 years will be significantly lower than your original YTM calculation promised.
It's the ultimate irony. High coupon bonds, the ones that pay you the most cash every year, actually have the highest reinvestment risk because you have all this cash constantly spitting out of the bond that you desperately have to find a new high-yield home for.
Whereas zero coupon bonds, which pay nothing until the end, have zero reinvestment risk.
Precisely. And the final risk is real interest rate risk. This is the macroeconomic bedrock. Even if inflation is completely flat, the fundamental cost of money in the economy can shift due to massive structural changes.
Yes, things like shifts in the global supply of savings, changes in taxation laws, or massive government borrowing crowding out private investment.
If the government decides to borrow ₹1 trillion to build infrastructure, they soak up all the available capital, driving the fundamental real interest rate up, which crushes the value of your existing bonds. It's a macro tide you cannot control.
It really is.
So taking a step back, with all these risks lurking in the shadows, default, liquidity, inflation, reinvestment, how does a normal investor, or even a pension fund manager, quickly judge if a bond is safe?
Well, they don't have the time or the manpower to audit a company's factory or read through 10,000 pages of financial statements.
Right. They rely on the professionals. They judge the book by the grade on its cover. This brings us to the gatekeepers of the debt market, credit rating agencies.
Independent rating agencies are the absolute watchdogs of the fixed income market. Their singular job is to rigorously assess the credit risk of an issuer.
They are essentially grading the likelihood that a company will make timely repayments of interest and principal over the life of the loan.
Exactly. If you are looking at the Indian context, there is a big five oligopoly of rating agencies you need to memorize. CRISIL, CARE, ICARA, Fitch, and Brickworks. These are the institutions handing out the report cards.
But before we talk about how they calculate those grades, we need to understand what a credit rating actually is in a legal and practical sense, because there are massive misconceptions here. Let's look at the actual features of these ratings. First, they provide up-to-date and recent information. They offer a low-cost, aggregated summary of risk to lenders. They carry immense credibility in the market, and they act as a severe disciplinarian force on corporate borrowers.
Let's expand on that disciplinarian aspect. If a CEO decides to recklessly borrow billions to fund a vanity project, the rating agency will immediately downgrade their credit rating from, say, AA to BBB.
Ouch.
That downgrade acts as a massive financial penalty because suddenly every new bond the company tries to issue will have to pay a much higher interest rate to compensate for the newly perceived risk. It keeps corporate recklessness in check.
But here's where we hit the exam traps. The misconceptions. I want to play the role of a naive retail investor. I log into my brokerage. I see a bond issued by a steel company. CRISIL has rated it AAA highest safety.
Okay.
So I conclude CRISIL is officially recommending that I buy this bond. It's a guaranteed slam dunk investment, right?
Absolutely not. And if you write that on an exam, you will fail the question. That is a critical misconception. Credit ratings are explicitly neither recommendations nor guidelines for investment decisions.
But it says highest safety. Why isn't that a recommendation to buy?
Because safety is only half the equation. The other half is price. A AAA bond might be mathematically incredibly safe, meaning the risk of default is near zero.
Right.
But because it is so safe, the market might have priced it at a massive premium, meaning the yield you actually earn is a microscopic 1%. It might be a mathematically terrible investment for your specific portfolio goals. The rating agency is only giving you a statistical probability of default. They are entirely agnostic about whether it is a good price to pay.
Wow. Okay, here's another misconception. The text says they do not provide an evaluation and analysis of the performance of the debt-issuing organizations, since these ratings are security-specific. So if I see a AAA rating on a specific corporate bond, that does not mean the rating agency thinks the company's stock is a good buy or that their new product line is going to be a massive hit.
Correct. They are not stock analysts. They are not grading the visionary leadership of the CEO. They are looking at one specific legal contract, this specific bond, and asking one narrow question.
Which is?
Will the cash flows over the next 5 years be sufficient to cover this specific debt obligation? A company could be slowly losing market share and headed for long-term irrelevance, but if they have enough cash hoarded to pay off a 3-year bond, that short-term bond might still get a high rating.
And crucially, these ratings do not create a legal relationship between the agency and the investor. If you buy a AAA bond and the company unexpectedly goes bankrupt the next day due to massive hidden fraud, you cannot sue CRISIL for giving them a AAA rating.
No, you can't. The rating is legally classified as an educated opinion based on the data available at the time, not a legal guarantee.
And finally, it is a continuous process. A rating isn't stamped on a bond in permanent ink. It is constantly monitored and revised up or down as the real-world economy shifts.
So, understanding what a rating is, the next logical question is, how do these analysts actually come up with the grade? What happens when a team from ICRA walks into a corporate headquarters?
They focus their investigation on 4 specific pillars: earnings capacity, leverage, liquidity, and the indenture.
Let's act this out. Let's send an analyst into our hypothetical airline. Pillar number 1, Earnings capacity. This is the financial engine room.
The analyst is looking for sustainability. Are they actually making real money, or is it an accounting illusion? They look at the historical track record, the regulatory environment. They ask, does this airline have sufficient cash generated purely from operations to cover their requirements?
They are looking for quality of earnings. Anyone can juice their profits for one quarter by slashing maintenance budgets or selling off assets, but the analyst adjusts for that.
Oh, that's clever.
They look to see if the fixed assets and inventories are valued properly to reflect actual replacement costs. If the airline is depreciating their planes over 50 years just to make profits look higher today, the analyst will catch that and penalize their earnings capacity score.
Pillar number 2 is leverage. This is the core of debt analysis. It's the debt-to-equity ratio. How much of the airline is financed by borrowed money versus owner money? The critical metric here is interest coverage.
Interest coverage is a simple but powerful ratio. It measures the margin of safety. Let's say our airline earns 300 million rupees in operating profit in a year, and the total annual interest payment on all their bonds is 100 million rupees.
So 300 million in profit divided by 100 million in interest bills. The interest coverage ratio is 3.
Exactly. They can afford to pay their interest obligations 3 times over from their current earnings. Rating agencies love a high interest coverage ratio.
Because what happens if a recession hits? Say, fewer people fly, and the airline's profits get slashed in half, dropping from 300 million down to 150 million.
Because they had a coverage ratio of 3, even with their profits cut in half, they still have enough money to pay the 100 million interest bill. It provides a massive buffer against macroeconomic shocks.
If the coverage ratio was 1.1, a minor recession would push them instantly into default.
Pillar 3 is liquidity. This is entirely focused on cash and cash equivalents. A fund can generate cash through selling equity, raising more debt, selling fixed assets, turnover of current assets, and internal cash via net income plus depreciation.
The core question here is, if a massive unexpected crisis hits tomorrow, like a global pandemic grounding all flights, can you find the actual physical cash to pay your immediate bills?
This is vital because profitability and liquidity are not the same thing. A company can be wildly profitable on paper, but if all of their wealth is tied up in illiquid assets like massive half-built real estate projects, they might not have enough actual cash in the bank to pay tomorrow's bond interest.
And if you miss that payment, you are in default no matter how profitable your long-term projects are. Liquidity measures survival.
And finally, pillar 4. The indenture. This is a fantastic vocabulary word. The indenture is the legal rulebook.
I analogize this to a highly restrictive prenuptial agreement for a loan. It specifies the rights, the obligations, and the liabilities of both the borrower and the lender.
It dictates the mechanical terms, the timing of the interest, the exact maturity date, the call features. But more importantly for the rating agency, it contains the covenants.
The covenants.
These are strict, legally binding promises the company makes to protect the bondholders.
Give me an example of a covenant. What kind of rules do they set?
A covenant might explicitly prohibit the airline from paying out a single rupee in dividends to the shareholders unless they maintain a certain cash balance. It might restrict them from taking on any more senior debt from other banks.
Oh, wow.
It might forbid them from selling off their most profitable routes without bondholder permission. It is the bondholders building a legal fence around the company's assets to ensure they don't get gambled away.
It's the lender saying, we will give you 1 billion rupees, but you promise not to go to Vegas and put it all on black.
Yeah.
So if an analyst looks at a company and sees highly sustainable real earnings, very low leverage with a massive interest coverage buffer, oceans of liquid cash, and an ironclad indenture protecting the lenders, CRISIL is going to stamp that bond with a glorious AAA rating.
And if they see declining earnings, massive debt, zero cash, and weak legal protections, they are assigning it a D for default, and the bond will trade at a massive discount if it trades at all.
Precisely. That 4-pillar framework is exactly how the micro-level assessment of a single corporate bond works.
But here is the final piece of the puzzle. We have spent an hour zoomed in on individual companies, individual cash flows, and individual rating analysts.
But no company and no bond exists in a vacuum. The baseline interest rate that a company has to pay isn't just decided by their credit rating. It is dictated by massive, invisible macroeconomic forces that determine the cost of money for the entire country.
This brings us to our final frontier, the macro view. Interest rate determinants. What actually decides the baseline interest rate in an economy at any given moment?
To answer this, we move from corporate accounting into macroeconomic theory. There are two major theoretical frameworks that explain the level and the changes in baseline interest rates. Theory 1 is the liquidity preference theory. Theory 2 is the loanable funds theory.
Understanding the conceptual difference between these two is the final key to mastering this unit.
Let's tackle Theory 1, liquidity preference theory. The core focus here is entirely on the concept of money, specifically liquid cash, at a specific point in time. It's about supply and demand for cash itself. Let's look at the demand side. Why do human beings demand to hold liquid cash instead of investing it?
According to this theory, the demand for money is driven primarily by the aggregate income of the population. The greater the national income, the greater the demand for holding liquid money to facilitate daily transactions, business operations, and precautionary savings.
Mathematically, it is expressed as a function. Demand for money is a function of interest rates and gross national product.
So if the country is booming, factories are running at full capacity, people are getting raises, they need more actual cash in their bank accounts to buy goods, pay suppliers, and live their lives. So demand for money goes up.
But the theory notes a crucial inverse relationship with the interest rate. If interest rates in the economy are sky high, say 15%, the opportunity cost of holding cash in your wallet is massive. You are losing out on 15% guaranteed growth.
So people take their cash out from under their mattresses and lock it up in bonds. The demand for holding liquid money drops drastically when interest rates are high.
That is the demand side driven by human behavior and income levels. The supply side in the liquidity preference theory is entirely rigid. The supply of money is strictly controlled by the central bank in India, the Reserve Bank of India.
They're the ultimate masters of the money supply. They use monetary policy tools like the cash reserve ratio, which forces banks to hold a certain percentage of deposits in vaults, or the statutory liquidity ratio. They essentially turn a giant valve, injecting liquidity into the banking system or draining it out.
So if you merge the two sides, the equilibrium interest rate in the liquidity preference theory is the exact intersection point where the public's organic demand to hold liquid cash perfectly matches the strict artificial supply of money dictated by the RBI's policy valves.
Yeah.
It is a clash between public income behavior and central bank mandates.
Now, let's contrast that with Theory 2, the loanable funds theory. This is fundamentally different. It doesn't look at the desire to hold liquid cash. It looks at the organic action of saving versus consuming. It focuses on the demand and supply of loanable funds.
Let's build a microeconomy to understand this. Where do loanable funds actually come from? They come from the surplus sector. These are households, highly profitable businesses, or governments running a surplus, where their current income is greater than their current spending.
When a family decides not to buy a new television this month and instead puts 5,000 rupees into a fixed deposit, they are supplying loanable funds to the national pool.
And what motivates that family to delay their gratification and save more? The interest rate. The higher the interest rate offered by the banks, the stronger the psychological motivation to skip the television and save the money. A higher interest rate organically increases the massive supply of loanable funds in the economy.
On the other side of the equation, who is demanding to take those funds out of the pool? These are the deficit spending units. A young couple wanting to borrow money to buy a house. A corporation wanting to borrow money to build a new semiconductor factory. A government wanting to borrow money to build a national highway system.
They want to spend more than they currently have, so they demand loanable funds by issuing primary securities, like mortgages or corporate bonds.
But there is a ceiling to their demand. If interest rates are 20%, the young couple cannot afford the monthly mortgage payment, so they cancel their house hunt. The corporation calculates that their new factory won't earn a 20% return, so they cancel the construction project. High interest rates organically destroy the demand for borrowing.
Therefore, the equilibrium point in the loanable funds theory is the exact organic market point where the aggregate demand for borrowing by deficit spenders perfectly equals the aggregate supply of savings offered by surplus units. It is the pure, raw market clearing price of delayed gratification.
Let me summarize the crucial distinction for the student preparing for the exam right now. How do you tell these apart on a multiple choice question?
Oh, that's helpful.
If the question is talking about the central bank, the RBI, rigidly controlling the supply of money using policy tools to meet the public's need for liquid cash transactions, that is the liquidity preference theory.
And if the question is talking about human households and businesses making organic decisions about whether to save their surplus income or borrow money to fund a deficit project, that is the loanable funds theory. The macroeconomic interest rate you use to value a corporate bond is ultimately born from the interplay of these massive theories.
That is the perfect distillation. One focuses on central bank mechanics and the form of wealth. The other focuses on the organic market behavior of savers versus borrowers and the action of wealth.
And with that final macroeconomic pillar in place, we have reached the summit. Listener, I want to formally congratulate you. You have survived a grueling, comprehensive deep dive, and you have conquered fixed income securities valuation.
Look at the journey we just took. We started with the foundational legal architecture of a bond. You now know you are the silent VIP lender with zero voting rights, but absolute first dibs in a bankruptcy lifeboat.
We walked through the zoo of corporate instruments, dissecting exactly why a zero-coupon bond differs from a participating bond. We dragged you through the essential math, proving that the intrinsic value is just discounted future cash flows. We established the ironclad inverse rule of perpetuities, and we demystified the trial and error reality of yield to maturity.
We balanced the seesaw of interest rate risks, learned the silent theft of inflation through the Fisher effect, and mapped out the trap of reinvestment risk. We unmasked the credit rating agencies and walked an analyst through the 4 pillars of corporate health.
And we finished by zooming all the way out to watch the macroeconomic tectonic plates of liquidity preference and loanable funds shift the ground beneath our feet.
You are officially equipped. You don't just have rote definitions. You have the structural blueprints. You have the conceptual why behind every single formula. You are ready to crush this exam.
It has been an incredibly rigorous journey through the hidden mechanics of global debt. But before you close your notebook and head into that exam room, I want to leave you with one final, real-world thought to ponder that goes beyond the safe confines of your academic syllabus.
Lay it on us.
Yeah.
What's the final takeaway?
Throughout this entire chapter, you have learned the precise, elegant mathematics required to value a bond. You take a predicted interest rate, you take a predicted inflation rate, you run it through a compounding discount formula, and it spits out an exact to the penny intrinsic value. In a textbook, it feels like a law of physics. It feels certain.
But think about the reality of the last few years. Think about massive, unpredictable global aims, a sudden pandemic that shuts down global trade, a geopolitical conflict that spikes energy prices, a collapse of a major shipping route. These black swan events force human beings at central banks to panic. They force them to slash or hike interest rates overnight in desperate, reactive moves.
So the question is, when the macroeconomic pivot of the seesaw is controlled by panicked human beings reacting to an unpredictable world, is the mathematical intrinsic value of a 30-year bond truly a fixed, objective truth? Or is it simply the market's best, highly educated, but incredibly fragile guess at one specific fleeting moment in time?
The math is flawless, the formulas are perfect, but the inputs are entirely human.
I absolutely love that. Keep questioning the numbers, trust your frameworks, and good luck on your exam. You've got this.